Good morning, folks. How are you? All right, so if you would be so kind as to let me know on Twitter that you guys can hear me. Everything's okay on audio. I'll begin. Thank you, Wayne. Just looking for a couple more people to confirm they can hear me. Manuel, thank you. Blanc, thank you. All right, thank you. So obviously I'm under the weather a little bit. I have a little bit of a cold or a virus, whatnot. So I'm gonna try to go through this not quickly and rushed, but I want to go through it to the point and then break away. My end time in this live stream is going to be by 9 o'clock or sooner, depending upon how I go. But I want to cover a little bit about yesterday's trading, and we'll watch at 8:30 the PPI number release, and then watch that for a few minutes, and then I'll close the session out. All right, so let's get on with it here. We have a daily chart here on NASDAQ. I want to take your attention to this area right in here. July 17th, 2024. That's a SIBI, sell side imbalance, buy side inefficiency. Now you want to grade that. So what you would do is take your fib, put it on this candle's low to this candle's high. And this is your midpoint, consequent encroachment. This is the high, this is the low. And you want to add the quadrants here. So this will give you the upper and lower quadrant inside of a range that you're grading, or a price swing. So you can do a implied dealing range where you're anticipating the market to deliver in the direction of your target, and you can run a grading using a fib and predict where the algorithm will start to accumulate or distribute new position entries on a longer term price run, or unrealized price target being met while prices going higher or going lower when you're bearish or bullish. I have lessons for that, by the way. It's in the core content lessons on the YouTube channel for free. But the upper quadrant level, consequent encroachment, and lower quadrant level. So you can see we failed on this run here on September 26th. It failed to even get to consequent encroachment there. And then yesterday, we were working the lower quadrant. So just be mindful that that 20,489 level, that level was more or less the level I had in mind, because I saw that it failed on this one here. I'm not abandoning the long-term bullishness on this market because it's an election year. They're really trying to fluff it up, put lipstick on this pig to make it look like the economy's strong, when the stock market has no direct correlation to the economy. It's a casino. So with that in mind, while I did tell my students that this 538 is the intermediate term draw, that means what's based on a daily chart. That's where the market's likely to pull to next, but I don't need it to go there, which is what I showed yesterday in the executions. So I'm going to give you a little bit more detail, but just know that we're working the lower half of this shaded area here. And because of that, I'm sticking to the likelihood of it wanting to reach further. So being long or going long has been predominantly the larger size of my leverage. So if I'm going to go short, I wasn't all that interested in being short anytime this week, but the fact that we have unrealized portions of this inefficiency traded to. So all of this halfway point, or just below halfway, because it only went to that candle's high there at 538, and you still have 568, which is half of the range between this candle's high and that candle's low. So knowing those things and trying to avoid being quote unquote right, because I'm not teaching you to be right, I'm teaching you to focus on low-hanging fruit objectives, sticking with a bias, sticking with a directional draw on liquidity that's based on a higher time frame chart, i.e. the weekly or daily, and then sticking to that and waiting for time and price to agree. So Just know that this level here, 538, is, in my mind, the draw. But I have to have something that's less than that for a low-hanging fruit objective to reach for and be content with it. Meaning that my trade idea would be satisfied taking something close to this level, but not requiring it to be at that level, but still have sound principles around it to justify why taking that exit is warranted and not just holding on for this objective here. Okay, so with that context, I'm going to drop down into this little area here. I'm going to remove these lines just because I don't want it to be confusing. Now, if you look at what we have on the highest candle here, on September 26th, the high comes in at 20,538. Full disclosure, I've told my students in private mentorship, this is where my draw is for the week. I want to see it trade there. Does it need to trade there? No. What would I take as a consolation? Like, what would be a low-hanging fruit objective? That's what I'm about to flesh out now for you. So half of this range between this candle's close to that candle's high is this level here. So this premium wick is a array where we split it in half because a wick is a gap. So half of that gap is 20,442 and a half. So Thursday, this is the candlestick for Thursday's trading. Now inside of this, what would look like on a daily chart, by all intents and purposes, you can see that there's nothing really inherently exciting about that candlestick. But you also watch me buy near the low and sell near the high based on the things I'm going to show you here. So we also have this level right there, which is the upper quadrant of this premium wick. And I'll show you what I mean by that. I'm going to add all the levels again. So you can see the halfway point. In this case, it's consequent encroachment, 0.75, 0.25, and the high and low. Base figures for anchoring your fib. So that's the closing price on the 26th of September to the high of that candle. The upper quadrant is 20,490 even. Consequent encroachment is 442 even. Lower quadrant's 20,393.75. And then you have the low of this wick, which is this candlestick's close. Okay, so the upper quadrant level right there, when I take the fib away, or not the fib, but I take the quadrants away, you'll see that that's the reason why that's anchored as it is. See? So this blue line here that's dashed, that's what I'm aiming for. And I don't require it to trade up to the high of that wick. You see what I've just done? I've traded with the idea that it could trade to the 538 level. I could be right technically, and I could have a higher target objective being met, and my exit would be even more profitable. But I don't need to do that. I'm teaching you how to take the probabilities and then reduce them down to a larger degree of accuracy and remove the tendency to feel like you have to be right. Being right is not, doesn't equate to being profitable. You can be wrong and be profitable. You can be wrong and still grow your account. And every trade that you actually try to trade to a specific target and price, it may never touch those objectives, and you can still be adding new equity to your bottom line. So focusing on being right or focusing on trying to avoid losing trades, that's a thing that is going to cycle through constantly if you have a loser's mentality, or you don't have a model, or if you haven't done back testing enough to solidify the things I'm teaching you. So just know that this is the range I was dealing in. It's this candlestick's wick that I'm aiming for the targets on. So what am I going to use as a discount to enter on? Well, now we take our attention over to October 8th. Now notice that we're doing all this work on the daily chart. We're not inside 1 second charts, 5 second charts, 5 minute charts, 60-minute charts. We haven't even left the daily chart yet. So I'm framing the context, how the algorithm is going to refer back to these price points from the daily perspective. Okay, so sticking with the higher time frame, order flow being bullish still, it's an election year. I want to still focus on heavy leverage on longs. And I don't need to be right. So we're framing high probability with low risk entries. This candlestick has a wick as well. See that? Now I'm going to add, again, 2 boundaries. And since it's a short and stubby type of wick compared to, and by contrast, this one, it's only important to know what the midpoint is, okay, or consequent encroachment. So this wick right here, from high to the close of that candlestick, I want to know what the halfway point is. So that's consequent encroachment. So because price opened up here on Thursday and traded down, okay, well, as soon as it opened up here, this makes this a discount array. That means it's going to reprice down to it, but not only is it just going to trade to it, but my expectation is the algorithm will use this to facilitate some measure of support, accumulation, and then start to rally from there. So you can see, without any, more talking about, you can see how it used this wick right there, overshoots it by a little bit. That's normal. Remember, the wicks are allowed to do the damage. So we want to see something accumulate in this area here with a secondary or third reason to be long. And then let's drop down to a lower time frame charts. But just know that this wick right here and this blue shaded dotted line here, which I'll go back to just taking these off, you'll see that that is the Tuesday daily premium wick. Now, when I say premium, this is going to be a cause for confusion, because you heard me talk about this is a discount array. If I ever talk about a candlestick and I say it's a premium wick is going to be the wick on the high end of the candle. A discount wick would be a wick on the low of the candle. Okay, so when price is up here, this premium array is a discount relative to where market price is. So it's down there. So just think of it as a premium wick inversion. So it's treating it as a method of going down to go up. That's all it is. Okay. All right. So because we have this levels annotated, and we have Wednesday's daily high annotated here as well, we're going to drop down into the next chart. All right, so this is a 15-minute time frame. So right away you can see the Tuesday daily premium wick consequent encroachment level. To know it's a mouthful. You can see it trading down into that. And what else is in close proximity to that level at the time that price trades down to it? What do you see? You see that gap right here? So we can look at it like this. I'm already losing my voice. Okay, so you have a gap here, and you have Tuesday's daily premium wick consequent encroachment there. And it happens after we get a low form. Notice that? So right away, this is the level I was pointing to on, actually, no, it's not true. In Twitter, I was looking at these relative equal highs here, and I noticed on the 1 minute chart. And if you go back and look at Twitter, you'll see that I had noted this before the CPI number was released at 8:30 yesterday on Thursday. I took everybody's attention and said, I like 20,474. It's smooth. It opens at the CPI number, goes right above that, does not take out the high over here, trades to that, runs the liquidity there, and then drops down, trades into the fair value gap there. Comes back up a little bit, institutional order flow entry drill here, and then dumps down once more, trading into Tuesday's daily premium wick consequent encroachment, which I showed on the daily chart. And then we're at the low, and then it's allowed to do what? Color outside the lines. This is a mohawk. Okay, so inside this mohawk, I'm going long because I'm fulfilling several things here. The market cleared, stops there, dropped, showed a reaction, went to the furthest extreme of that fair value gap right here, this one right here, okay? trades to the low of it, and then goes outside of it a little bit. That's completely normal. It's absolutely normal. And I want to accumulate a long position based on that and anticipate trading up to in the direction of 20,538 on the daily chart. But remember, I don't need that price level. All I need is to trade it to this right here. This dashed line here. Remember what I just said on the daily chart. This is the reason why you're supposed to be writing notes. As I'm talking, you're not going to know or remember what that level is if you've just been watching and just eating potato chips and not paying attention or playing Xbox. You have to pay attention and understand what I'm referring to. And then you have the relative equal highs here. But just above that, how far can it go? Go back to that daily chart and you'll see that that's that level here that I'm annotating. So I want to see this price level traded to. So again, if I think it can trade there, how else can I refine it so that way I have a high probability exit strategy and not demand the 20,538 level, not demand the 20,490 level. So I can choose what? I can choose something very, very small and short term, and it's this high to this high and the high here. So that's why I had my limit order. You'll see it was in the post yesterday and what I'll show here in a moment. So the market then creates all this consolidation, accumulation, and then runs up and bumps the objectives. Did not get to 20,538, and I don't need it to trade here. Okay, so I do believe that the 20,538 is still in play and still a factor for me, but it's not necessary for what I was using yesterday. And then we're moving over to a 1 minute chart. So you can see the levels that this added, which is that fair value gap, and then the initial low, the consolidation, and then drop down at the market opening. Here is the 931 minimum threshold for time. You can't make it earlier than that. So 931, that's your first presented fair value gap. It's small, but it's okay. It's still useful. And the market dives down and trades just below that fair value gap that I showed on the 5 minute chart. So if I scrub over here and show you in the 1 minute time frame where these two blue lines are annotated, it doesn't look like there's a fair value gap at all. So that's why you have to cycle through your time frames down, and you'll be able to refine any inefficiencies, but there's no refinement necessary in here because it's a lot of back and forth delivery, see? So it's all back and forth between this candle, between this price range and this price range defined by those blue lines. It was anchored on the 5 minute chart, and the 1 minute chart, it doesn't look all that inefficient, does it? I'm going over here